welcome back. You're watching Power Breakfast on CNBC-TV18. Well, on Dalal Street yesterday, the market snapped its six-day gaining streak to close in the red. The Sensex shed over 300 points, while the Nifty slipped by more than 0.5%. Meanwhile, from the broader markets, Bank Nifty outperformed to end 1% higher, and the mid-cap index also ended with minor gains. Sonia Shenoy joins in to get us all the market cues we need to watch out for trade today. Hi, Sonia. Good morning.
Hi Sonal, good morning and thanks for that. Well, it was not entirely unexpected that after 6 days of gains, the market finally closed in the red. In fact, Infosys was the one that really soured sentiment yesterday. It saw the biggest one-day fall in the last 6 years. And if you look at it, despite the fall we saw yesterday, the Nifty is still in an uptrend. It's just about 500 points away from that all-time high of 12,103. But yesterday we saw selling both from FIIs and from DIIs. So that's a bit of a concern, perhaps taking away whatever profits they have. So FII sold 557 crores in the cash markets. They've sold in cash after 6 days of buying, and domestic institutions also sold about 985 crores in the cash market. The US markets also saw some minor pressure yesterday. There were weak earnings that came in from the likes of McDonald's, from Procter & Gamble, etc. But the level to watch on the Nifty now is that 11,700 zone. Remember, it has proven to be a bit of a hurdle in the past as well. So perhaps this time around once again proves to be a bit of a resistance mark. And now you have the second half of earnings season coming through. So a lot of accidents, a lot of weak numbers. Perhaps that could continue to dampen sentiment in the market.
All right, so now you said a lot of earnings are expected as well. Let's hope we get a couple of positive surprises as well coming in there. What about stocks we're looking out for today?
Well, I don't want to dampen your hopes or dash your hopes, but there were a lot of weak numbers that came in post-market hours. I think RBL Bank tops the list because the profits were down 74%, coming in at just about 54 odd crores. And the management commentary was very cautious. They say they expect stress of 1,800 crores, including from 4 groups, and the economic environment has become very challenging. So that's one stock that could be the big stock on the downside today. Apart from that, a lot of big earnings coming through today. There's Hero MotoCorp, Bajaj Auto, HCL Tech, L&T, Biocon, IRB Infra. So, a lot of economy-facing stocks coming out with earnings would be an important barometer to see which way things are headed. Some more numbers. Asian Paints, the margins were a bit of a disappointment, below expectations at 18.9% versus a 20% expectation. So, the stock has also been trading at highs, record highs, so perhaps there could be some profit taking today. Axis Bank had a very strong quarter. The management says that the margins in FY20 will be higher than FY19. The asset quality was stable. The retail loan growth was very strong at 23%. So I expect Axis Bank to be in the green. SIAG, the numbers were weaker than estimated. The revenues fell 5.5%. The profits were down 12.5%. So that stock could be under pressure today. M&M Finance had a strong AUM growth and stable asset quality. So that stock in fact ran up yesterday in late trade as well. So maybe there could be some more on the upside. And finally, Jubilant Foodworks was the big stock that moved yesterday post a strong set of numbers. HSBC has raised their target price to 1,700 from 1,500 on the stock. They say that the same store sales growth has improved despite a challenging environment. Back to you.
All right, Sonia, thanks a lot for joining in and telling us what all stocks that we need to watch out for today. But it's Diwali week, and as we get set to usher in Samvat 2076, hear out what our market masters have to say on the outlook for the market and strategy going ahead.
The top 50 companies, as Ramdev is saying, have taken the bulk of the flows away in the market. Also, another friend sent me some data recently where he said since the norms came out last year about local mutual funds not being able to do style drift between large caps being 25,000 crores, mid caps being 8,000 crores, and then the smaller ones being 3,000 crores. If something falls from 25,000 to 22,000, the fund is forced to in a way sell it rather than adding to its position. And that may have kind of accentuated the pain. So you put these two things together, the carnage which has happened in the broader market is unprecedented. If indeed the revival has to come, at some point the trade will move away from quality because, again, like Ramdev and I have often expressed, the markets discount what is the rate of change. So you may go from terrible to bad, and that may give you a rate of change, which is not necessarily the best portfolio to hold long term, but there is a trade over there.
We are buying QG, quality and growth. So there, I think today market is actually looking high or almost all-time high because the QG stocks are doing very well. So my portfolio is positioned for this particular kind of rally. Not that it has done some great numbers, but it is at least not showing too much of downside. I think the kind of pessimism we have gone through, I mean, fundamentals only time will tell, because still a lot of these 6 parameters he talked about still in dogs. So, but I think we have seen some amount of bottoming out of the pessimism, like intense pessimism which we saw, and that led to government also coming back with a lot of steps, and they are committed to do even more. They have literally thrown the fiscal to the thing. I mean, people are counting and counting, but I don't think there is any number. So fiscal side is gone. RBI is very proactive on the liquidity, cost of money, whatever is possible.
Actually, the problem is not in stock market, if you ask me. People are buying stocks. The problem is that today you have AA companies and companies which we think are AA. They are raising money at high rates. And I believe that the problem is that people are not willing to take risk in debt. And in my opinion, that is the whole problem rather than the problem in equity markets. Because what is happening is all the companies which require debt, which are decent, not junk, they are not able to get money in debt actually, and that has become a problem, and the borrowing costs for them have gone up because somewhere people want to lend only to safe companies. Essentially, you bet on companies and sectors which have delivered no returns for 12 years. Power, telecom, some of the infra spaces, corporate banks. And I mean, increasingly, if you look at from 2017 top, even many of the small caps, other than some quality small caps, have hardly delivered returns. So I believe that you have a wide variety of stocks and sectors which have delivered no returns for 12 years, which I think are looking appetizingly interesting, because if you have not delivered returns for 12 years, no one enters a sector, and therefore incremental competition from new entrants comes down to zero.
Okay, all right. Time to slip into a short break then. But up next, the government is saddled with a demand of over 1 lakh